Next panel is entitled Strategies for Financial Recovery and Future Growth. And I'd like to hand over directly to the panel chair, Bob Maguire, Managing Director at the Carlyle Group. Bob.
Thank you. I always think it's a good idea in these discussions to start by making sense of the title of the panel. What we have in the program is Strategies for Financial Recovery and Future Growth. And I think if you work through that, it sets this discussion up, because if you think about what's happened the last couple of years, the financial strategies in the industry have been primarily about survival, and people have been focused on protecting dividends, particularly if you're a major, and it's all about protecting the dividend at whatever cost, including elimination of capex. So as soon as you turn the corner where you're starting not to worry so much about protecting the dividend, your shareholders then are going to come back to you and say, where's the growth coming from? And the problem is, for the past few years, you haven't been investing in that inventory of growth projects, exploration, development, what have you. And now you've got a problem, because you can't just sort of reverse that 2 years of inactivity and deliver what your shareholders now want in a recovering environment. So that's a problem. And the question is, does that create, stimulate strategic activity or not? Is that one of the byproducts? But I think one of the primary features of the industry in the last few years, at least as it relates to strategic activity, is really how little of it there has been. I mean, there really has just basically been a shutdown of M&A activity, maybe less so in North America, but in general, I think it's true across the board. And so a question that raises, first of all, is why is that? What has caused that? Why has that been? Second, whatever has caused it, is it going to change? Why will it change? When will it change? And if it does change, what's going to be new? What's going to happen next? Now, that's clearly a function of outlook for commodity prices. And again, it's not so much what the commodity prices are actually going to be, it's what people think they're going to be that's driving it. It's cost of capital, it's pricing of assets, it's availability of capital. And lots of these kind of things working together. Now, what we have today in this panel, I think we have a group of people who can reflect both a kind of macro view to kind of frame the macro issues, an advisory stroke strategic viewpoint from providing strategic advice to the industry, what's happening at the grassroots level amongst the companies, and then also the possibility of people looking at it from the principal's point of view. So we have in this panel a kind of combination of people who are at once providers of capital, users of capital, advising, taking advice in the U.S., outside the U.S. There's a lot of sort of different themes that work through the experience represented in this group. And what I'd like to do to start the discussion is ask first for David to set the scene on the macro level, particularly if it's true to say that we are looking at a recovery. I mean, it little feels that way, but I'm not sure how sure it is.
So I think a recovery's happening. You heard Paul say it yesterday. It's not popular to say it, but the oil market is undersupplied. How do I know that? I look at U.S. inventories. The last 6-8 weeks, they've been underperforming normal trends. Why do U.S. inventories matter? One, we get them on Wednesday through last Friday, so they're current. More importantly, U.S. inventories 2 years ago accounted for 45% of OECD total inventories, crude plus products. They've represented 70% of the growth. So if you want to see the decline, you're going to see it in the U.S. first. U.S. inventories are starting to trend better than normal. Markets undersupplied. The OPEC cuts are going to accelerate the drawdown of excess inventories. This time next year, prices are going to be materially higher than the $54 to $58 range that folks guessed yesterday. So, but that's easy for me to say. But when you look at folks involved in the public markets, you have a wide range of conviction. So look at long-only investors. So let's think about equity prices for companies with good acreage and good balance sheets, right? You have to dial in $70 a barrel price to get to the current stock price. So investors, the long-only investor who doesn't have to get the timing exactly right, is the most bullish guy in the room. Who's the most bearish guy in the room? It's the board member who's saying, okay, I've heard this story before and been head faked, and I'm worried that if prices go down again next year, our balance sheet's going to go the wrong direction. So when you think about what companies are planning for next year, as I've talked to boards of directors, it feels like they're running the strip and the strip less 10, right? So think about low 50s to low 40s for your price deck next year for planning. That's not a scenario where you're going to see folks really lean in to activity and lean into growth. So you have, so when will companies get more optimistic? When the price gets better, right? That's what's going to happen. They're going to follow price, and so the equity investor who's involved is going to be okay. So you have this. You almost have to let the price lead the way because people are so beaten down over the last couple of years, and we've been head faked a couple times. And just a quick word about natural gas in North America. For the first time in my career, you can't have an opinion on North American gas if you don't have an opinion on crude. Because when we think about growth, we dial in growth for North American crude oil of about 600,000 or 700,000 barrels a day annually, starting in 17, 18, 19, or 18, 19, and 20. That provides enough associated gas that meets half of our gas growth through the end of the decade. That gas is necessarily high liquids rich, lots of NGLs, and that creates an environment that is favorable for a robust petrochemical business on the Gulf Coast as well. So there are a lot of follow-on effects. But if you say crude can't grow or doesn't need to grow, then we need a higher gas price to affect growth just from traditional gas basins. So the North American gas market's gotten a lot more complicated in the last few years because of the associated gas produced with oil, and that tends to be liquids rich. So it's a fascinating time we live in. So I'll leave it there for now.
Good. So a perception that prices are strengthening, heading in the right direction, but not enough conviction yet?
Correct.
Yeah. Colin, in your advisory business, now this is going to be more outside the U.S. than inside, but is that what you're seeing at the grassroots level with your clients and the people that you speak to?
Well, it depends where you are, I think, and geographically as well. I mean, maybe I'd talk a bit about the strategies that companies have adopted through this downturn and what's happening just now. And on the E&P side, of course, no different from previous downturns, the focus is all on slashing spending. But there are a few companies that have done some smart things, and EOG and Pioneer, they've improved the quality of their businesses by adding high quality acreage and developing new technology to improve efficiency and also raising additional capital. Enquest in the UK overhauled its procurement culture, vast reductions in its operating costs, and has used supplier financing very effectively to keep building its resource base in the downturn. But I think culturally the really big E&P companies are just not set up to do that, and they could maybe learn something from these guys. On the service side, I think this downturn started with a feeling of let's cut the fat and get really efficient. But I mean, service companies have had to cut and cut and cut simply to survive. And I mean, they're now cutting people they don't want to lose, and they're closing facilities they don't want to close. And so the business capability there is now being impaired, and there's a price to pay for that in time. I think there are service companies that have specific expertise, very well managed, and they're managing to survive just by diversifying into nuclear and renewables and defence and aerospace. But generally, it's everyone's got their hard hats on, and it's cut. And this downturn, it's gone on for so long that actually most of these service companies are EBITDA negative now, and that's just not sustainable. And layer onto that, I mean, the banks are putting a lot of pressure on. Companies that had prudent debt levels 2 years ago, their revenues are 75% down. You can't cut costs any further, and so the bank debt is now completely out of kilter with equity value, and that's resulting in multiple failures. So, I mean, I think we're going to lose a huge proportion of of our service base here in time. The change in the UK and the change in the banking rules means that the bank's ability to lend is already impaired, or was already impaired before the slump, and so the banks are very cautious. And unbelievably, even cash collateralized lending is actually coming under pressure right now. I mean, it's crazy. Are there signs of a recovery in North America? Yeah, absolutely. I think there was a trough in Q2, but in international, I don't think there's any visibility on any form of recovery. Has the industry been reshaped as a consequence of the downturn? Make absolutely no mistake. I mean, these service pricing declines are not permanent. The E&P companies need to rethink the relationships with the service companies. And if you contrast the approach with aerospace, I mean, the aerospace business has been transformed on the back of long-term contracts that encourage R&D and innovation, and there's no evidence of that in the oil industry. Post-Macondo, big company, there was a view that E&P companies had to contract with big companies, but that's out the window now. I think that creates opportunity for companies with innovative and entrepreneurial flair. But those skills, I don't think, are fostered well in giant companies, and they're typically fostered well in small and medium-sized businesses. And if they can do things differently, then they'll be rewarded for that. I mean, I think it's worth remembering from a UK perspective that the UK oil industry was in crisis before the downturn. And given the significance of the oil industry to the UK economy, you might have expected a bit more government support. There's been a plethora of task forces and committees and conferences dedicated to encouraging all parts of the industry to work together for everyone's long-term benefit, but there's absolutely no evidence that that's actually done any good, and that's a major disappointment. Think about the carnage, given the interconnectedness of the industry in the UK. The carnage that would take place if a Premier Oil or an Enquest were to fail. It would drag down the partners, and there would be a massive, horrible ripple effect on the supply chain. And that, I think, would be like a Lehman moment for the UK oil and gas industry. And there's no lifeboat out there for that. In the deal-making space, obviously an E&P shift towards short-cycle assets in North America, insatiable appetite of the US capital markets. On the service side, why has there not been a lot of activity? Well, in a period of decline, when things are going down, it's difficult to complete a deal because corporate profits are in decline. Nobody has any idea when that's going to change. Everybody's nervous. And so that leads to a lot of deals being put on hold. But once the market troughs, many of those deals will come back. And there's absolutely evidence of that happening in North America. 2015 and the first half of 2016 was real quiet. But since February of this year, actually, the Simmons team alone has done 30 M&A deals and capital market transactions with a combined value of $12 billion. So, I mean, there is a turn there. One of the big problems is stalled private companies that were bought at the top of the market, 10 times EBITDA, 6 times leverage. Obviously 75% of the revenues disappear. Equity values underwater. There's no desire to put good money after bad, and the banks, start putting on the pressure. I mean, these companies are going nowhere, and again, that's impairing, actually the ability of the service companies to, when things do come back. As far as new investment is concerned, I think the general PE investors are scared to invest right now. But the specialist industry PE firms who understand the industry realize that now is actually the best time to invest, because when things move up, if they buy at low cost, they get a triple whammy of volume, margin, and multiple expansion, as the industry recovers. The problem is it's impossible to pick the bottom or to anticipate when an uptick will come, and investors are very nervous. And maybe they should heed the advice of Warren Buffett, who said that it doesn't matter how hard you try, some things just take time. You can't make a baby in a month by getting 9 girls pregnant. Thank you.
Did Warren Buffett say
Warren
that?
Buffett said that, yeah.
Okay. Great. Thank you. Now, so that sounds like everything's at the bottom. No one has capacity to do anything. People are waiting, for the trough. But David Foley, one of the things you said as a private equity investor, this is about oil and money. It's not a problem with money. There's a lot of money around. There's a lot of money, particularly in the PE space.
Yeah.
But what is the activity level looking like? What is the opportunity set that you see now?
So I actually have a couple of slides just to graphically illustrate the amount of deal activity. Let's see if this is kind of starting with why there's less activity, because money follows returns, and the sad fact is in this industry, it doesn't look so good. And so, a challenge for everyone in the room, to the extent you want to attract more capital from your shareholders, from your lenders, from private investors, we all need to do something about that return on capital. And this is, if you focus on the lower portion of the graph, this is through at least a couple of cycles, right? Over a 10-year average, S&P 500 energy index, the returns are only about 4%. That's less than the S&P 500. We've also got some of the global indices in there, the MSCI World Energy. And for this industry, average is actually pretty bad. If this was a healthcare or an IT conference, maybe everyone would be happier because the returns are much better, and you could make a good return and earn a good bonus by being average. But this is not an industry for average. Returns on capital are quite poor. It's a capital-intensive business. Sometimes people think of private equity as being a high-cost source of capital, but apparently, based on this graph, try as we might, we're actually not. We're not any more expensive than public equity. So I think for the industry, which has had challenges, frankly, earning a good return on capital when oils was at 100, now it's just as challenging, perhaps more challenging, to earn a return when oil's at 50. So I think we should all keep that in mind as we go forward in the industry. Balancing doesn't matter for any individuals in the room, really, if it's balancing, but you're still not making a return on capital. Industry volume overall, and this is outside of the U.S., has generally trended down a bit globally. Outside of the U.S., U.S. is generally averaged over the last decade about half of global M&A volume, but in the current year it's over 80%. Why is that? I think one, the NOCs tend not to transact quite as much. That accounts for a lot of the reserves and production outside of the U.S. And the U.S. has a very open regulatory environment, very vibrant capital markets. Although the first quarter wouldn't really have been characterized by that, since then the high yield index in the U.S. and a lot of the independent companies in the U.S. upstream have been financed by high yield. That cost was extremely high in the first quarter. It was a 19% current yield on the single B, so less than ideal credit quality upstream index. Most of those companies are U.S., and now it's gone down to closer to 8%. So the high yield markets are back open. The equity markets are back open. Banks are still a bit challenged, maybe more so in the U.S., especially for reserve-based lending. But it's not for lack of money, and I think the transactions are happening in the U.S. in part because that's where, in a more volatile crude oil environment, what do you want? You want to know your break-even's reasonably low, and you don't want to wait. You don't want to do a 10-year project. You might want to drill a well and get most of your money back within a couple of years. You can be somewhat confident you'll get a decent return with that kind of short cycle returns. That's why a lot of the money is flowing to the Permian. In terms of private equity, I don't think the industry has really distinguished itself. If you look at when the peaks of investment happened, timing wasn't so good for the industry overall. And that's, in part, it mirrors some of the public M&A activity. People tend to want to buy things after they've gone up for a bit and they're doing a straight line projection. that makes it very tough. We try to take, and I think some of the survivors in private equity try to take a bit of a longer term approach in an environment where sovereign debt is yielding 0 or less than 0. Getting anything with any kind of a return it requires taking on some risk. So we try to look for opportunities not just to buy businesses, and we do buy businesses, but most of what we've done at Blackstone over the last 20 years has been actually building businesses, so leasing acreage, hiring management teams, drilling it out, doing construction work, building power plants, more recently in the U.S., committing $1.5 billion to Cheniere to help them build the first liquefaction plant in the U.S. So that's a good way to play the cycle a bit. When public companies are overvalued, we don't try to buy public companies. We try to build companies that we can sell to public companies. So I think that if the industry can focus on returns on capital, there's still a bright future for the industry. I think you should look at private equity capital as it's much more flexible and it's a different kind of source. If you've got a very simple story and everything's going great, you can do an overnight equity offering if you need to. You can do a high yield offering without any problem. If you've got something that's a bit more complicated, your story requires a few years to play out, you need someone to spend more than 15 minutes in a roadshow to try to figure it out and invest alongside you, I'd say private equity's a good place to look.
Yeah. So those slides went by pretty fast. And I wonder...
Go back.
No, we don't have to go back. I think a question that I have, and probably the audience has, is in a cyclical industry, you expect a lot of it's going to be driven by timing, like we have here. And so the question that follows from that is, Colin, you said everyone's waiting for the trough. Are you guys now more worried about missing the turn, or are you waiting on the sideline because you think there's... Yeah, I mean, all of you, really. I mean, just start with you.
So we... so I run Blackstone's energy investing business, and we completed a second fundraise of a much larger fund at the very end of 14, start of 15, and despite every incentive to invest in 15, and it looked like the crash, some people thought it happened already in the fourth quarter of 14, and try as we might, we weren't able to consummate any new transactions in 15. There was a bit of the sentiment in the room now. Back in the second quarter of 15, prices went up, oil was 60, everyone's trained to buy on the dips, and public share prices were discounting much higher oil, so we ended up investing with our portfolio companies, but no new deals. And looking back, I'm kind of happy we didn't get sucked into that false recovery. And this year we've invested almost $2 billion of equity capital year to date. It's a mix of things from the Permian, thankfully earlier on in the year relative to later, because prices have gone up quite a bit. Offshore we like. Offshore is quite out of favor, I think, relative to shale. The costs haven't come down quite as quick, but I think in a well-structured project there will be cost deflation, pretty significant cost deflation offshore, so we like that. We've done some power. It's a mix. It's not just all about upstream oil and gas. Midstream power are important as well. And even Colin mentioned the North Sea. I think the North Sea's dead by a long stretch. There's still, you have to, I think, have a very tough screen. But we're actively investing in the current market.
Okay. So, it's about timing and calling. I mean, we've had other panels here where people have had to predict or guess or bet on oil prices. But as I said, it's not so much a question of what the actual price is going to be, it's the perception. Are we or aren't we, turning the corner? Is this the trough, Colin?
Well, I mean, at the end of the day, as long as you believe that the market's going to come back at some point, it doesn't really matter, whether you invest at the very bottom or within 10% of the bottom. I mean, the rising tide will always lift all the ships. But my sense is that things are absolutely in motion in North America. But the international is lagging absolutely horribly behind that. Yeah. And that's because most of the mind share goes to the shale business in North America. Mm-hmm. And also because the break-even points in short cycle assets are lower. There's lots of people out there that will tell you that the offshore and that deep water and that the international business is dead as a consequence of what's happening in shale. And I think the people that have been here in the last couple of days, obviously have a better appreciation that that's absolutely not the case. But that's the consensus view right now.
But an important part of the survival or the continued activity in this environment has been, the reduction in service and supply costs. So when we come to the trough, do you keep those reductions, or does the industry give them back to the service companies?
It's just inevitable that they get given back. I mean, for BP to think it's going to keep 75% of the cost reductions, I think is just, naive.
Yeah.
Because you get that scenario where, if no one's making money right now, they're not going to keep doing that for forever, obviously. But as soon as activity starts picking up, then there has to be some margin improvement, and then in time there becomes the multiple improvement, and so you end up with this fantastic uplift in value that comes from more volume, better margins, and better multiple. And so, David's chart's absolutely right. The statistics don't lie, but were you to be able to break that down into early cycle investments relative to, if you look at if you look at a ETF that follows all the public service companies in the United States, where it's a massive spike and back down. Obviously, those investors that invested at the bottom, they enjoy the ride up. But unfortunately, the way that the emotional intelligence works, if you like, is that investors tend to be happier investing actually 2/3 of the way up the curve, because they want to see evidence that someone else is making money ahead of them, and so they end up investing at the brow of the curve, and the inevitable things happen. So your graph there, I think, is the manifestation of some people who are really smart investors who invest at the bottom of the cycle, and some other people who are followers who invest at the top of the cycle. Basically one of them is making money at the expense of the other.
Mm-hmm. So David Pursell, what do you think? Are we trough or?
Yeah, look, I think it's pretty clear we're at or beyond a trough from a price standpoint. Activity will follow price. So let's talk about that a little bit. In the U.S., I've heard a lot of talk about rig counts up in the U.S. Well, let's put some numbers on that. Rig counts up 200 over the last 5 months from a really, really low level. So say from 370 rigs to 570 rigs. We think of that as the word in the States is that's a low calorie sort of a rig count. What do I mean by that? Private companies account for about half of that rig count increase. Rigs that are drilling vertical wells account for about half of that rig count increase. So there's only about 90 of those rigs that are really kind of high-end drilling horizontal wells. What's interesting about that is 0 of those rigs have gone back to work in the Eagle Ford, and only 5 of those rigs have gone back to work in the Bakken. So what's happening in the U.S. is a little bit of, to investors, it's, hey, look, a squirrel, like there's the Permian, and don't focus on the fact that my Eagle Ford investments are not generating a return, and the wells are declining faster than we ever thought they would. So people vote with their pocketbook, and what's happened, why is the Eagle Ford important? The Eagle Ford represented almost 40% of the production growth in the U.S. over the last 4 or 5 years. 0 new rigs. So rig count there is about 30 rigs. It peaked at about 230 rigs. 0 incremental activity in the Eagle Ford. But you're seeing 90 rigs growing. Most of that's going into the Permian, and only a handful into the Bakken. The Bakken and the Eagle Ford have been the drivers of growth in the past. They are not going to be the drivers of growth going forward. It's going to be the Permian. Why? Because they're not as good. And they probably, in retrospect, will show to be, there's probably been a lot of capital destroyed there. So be really careful when you talk about the U.S. as being a swing producer. We're not talking about the U.S., we're talking about 15 counties in West Texas and Southeast New Mexico that are going to be called on to drive significant production growth, and that's a real key point. I hear this talk of efficiency a lot, and efficiency, I've heard that a bunch, and efficiency is like calling a dog a non-cat, right? it's accurate, but it's not very descriptive, right? Efficiencies mean different things to different people. And when you hear an E&P guy talk about efficiencies, what's he talking about? He's talking about drilling times, right? Spud to TD, and that's what they talk about. Well, a rig that cost me $25,000 a day, if I shave 10 days off the drilling time, it's insignificant to the overall cost of a $6 or $7 million well. What really matters is your completions. And completions are getting more intense, right? And by the way, when folks talk, you'll hear people talk about new technology, we're pumping more sand. If pumping more sand is new technology, welcome to 1983, right? It is not. There is nothing new about what's going on. And so what's going to happen with this pressure pumping fleet that we're churning through because we're not spending any maintenance capital on it. It's sitting in the yard getting rusty with weeds growing through it. When the call comes for more frac equipment, that equipment's not going to be usable. And then the question is, where do the crews come from? So coil tubing business, probably number 4 player in the US, they've gone from 950 people to 230. Those 700 plus people are working. Where are they going to get them from? They're either going to money whip them to get them back, or they're going to have to go get a crew that can barely pass a drug test. In any state of the world, another 200 or 300 horizontal rigs up, efficiencies go the other direction, right? There's no way that the E&P companies can hang on to cost savings, let alone efficiencies, right? You see this Superman, hey, look at my efficiencies. Look, when you've got the best rig and the best crew drilling your best well, you better be putting up eye-popping efficiencies. And the question is, how do you take a full step back, a half step back, or 2 steps backwards when the activity ultimately starts moving the other direction? And so I think it's going to be a fascinating 12 to 18 months to watch, and keep your eyes on the service business, because it will be really interesting.
So, Colin, can I ask you a related question to that, which is UK specific, and maybe David Foley will have a point of view? As far as I know, it hasn't come up the last day or two, but Brexit. Now, Brexit is having an effect on costs in the UK.
Yeah, I mean, on cost, well, I think that what's the effect of Brexit on the industry in the UK? I would say that on the margin, it's possibly a net positive, because there's a burden of regulation that goes with being in the EU that probably gets lifted. But
what's sterling costs?
I think the bigger problem is the spectre of another Scottish independence referendum, which would, just be absolutely horrible, just in terms of the uncertainty that it brings to the industry. So that's just.
David Foley, do you care?
I'd say whether the UK offshore becomes the Scottish offshore or not, whoever the regulator is going to need to continue to move in the direction they have been recently, which is reducing the tax burden, providing incentives for investment if they want that source of ongoing royalties, employment, all the good things that the North Sea does for Great Britain. If they want that to continue, the commission, the work that was done to identify, why is the uptime so low, why aren't hub facilities being utilized, why aren't people investing? I thought that work that the government did was actually quite good, and they're starting to move in the right direction. So whether it's being done by the Brits or by the Scots, if they want it to continue, they'll have to keep that trend towards a bit more regulation that is accommodating of new investment.
And decommissioning, if Scotland?
Big market. I mean, it's a big opportunity, but it's a manana opportunity.
Yeah, but could Scotland pay for it?
Well, I think that's the big question. I mean, hopefully we don't ever have to answer that question.
No.
Yeah.
Maybe, I could just wave a little flag. We're talking again about the shale business, and just to put it in perspective. So, tight oil in the States is about 5 million barrels a day of what is a 96 million barrel a day business. And if you think about the proportion of the mine share that it gets, it's ridiculously out of kilter, actually. And if you think also about, everyone's been talking about the reduction in capital spending, 750 down to 330 or whatever it is. And also the fact that there's a gravitation of capital towards short cycle assets, to the shale. So if you kind of wave a red flag for international and offshore for a minute, you know, there's 90 million barrels a day that's not actually getting a lot of attention right now and is being starved of investment. And you know, what that feels like at grassroots level is pretty horrible. And you know, you'd only need to drive around the streets of Aberdeen right now to see what that looks like in reality. And you know, but I think that's an opportunity. I mean, I think that's an opportunity for guys like David to actually focus on what is actually an unloved part of the sector, because now is the time to invest in it. If you believe, you know, that it's an industry that's coming back, then you know, ignore the 90 million at your peril.
No, exactly, and that's an interesting question, because yes, there's lots of activity in the U.S. The U.S. is a very liquid market. The U.S. is a transparent market. You can get in, you can get out, but the question is, that must limit the return potential, because everybody's there, everybody sees it. The value dislocations are clear and therefore probably don't last.
Well, the only returns you tend to capture, I don't think it's service costs. I mean, to keep the benefit of service costs, an upstream company would need to control the price of what they're selling, which obviously, aside from maybe one person's here earlier say you really can't. So I think what you can do is you can get great acreage and figure it out before other people have figured it out. But most of that in the U.S. has kind of happened already. So then it does become productive beyond just service cost deflation. Productivity improvements. Is your team, you know, more cutting edge, and are you investing appropriately in, you know, if it's not shale, if it's offshore, and getting as much information as you can, as much analysis as you can before you start drilling.
Yeah, but it's really a private equity question. I think that on the one hand, you've got a lot of private equity capital in North America, which goes both ways. It means the investors like it, but equally the users of the capital are used to dealing with private equity. Do you think they're as used to dealing with that outside North America? There certainly isn't as much activity, but equally the users are not as familiar.
I'd say no, absolutely they're not. And one of the reasons, you know, I'm based in New York, but I'm spending more time here is because, you know, we do see, I think, what Colin says, which is the U.S. title. It's, you know, 5% of the market, and everyone incessantly talks about it. And yet, you know, I think there's a lot of opportunity outside the U.S. The challenges have been, and I think the oil companies in the United States have been grown accustomed to dealing with non-major. And if you look at how shale actually developed in the US, a lot of it was independents and either small caps or companies that were financed privately and with private equity. And it's hard. You know, we recently acquired a piece of a field here in the North Sea, and it's not the easiest thing to get, you know, the major who's the operator to say, well, who are you? You're not Shell, you're not BP. What are you like?
Who are you?
And are you going to be there to fund the capital to complete this and the decom? So I think it's an opportunity for private equity firms that themselves are well capitalized. I mean, Blackstone's got $330 billion of assets under management. We're not going away. We're not going anywhere. We're frankly a little more like as a firm, and from a reputational standpoint, some of the majors than we are an independent. And I think that'll be an education for the majors. And it's not just in Europe, but Africa and other places. The risk is more above ground than below ground. And so being able to deal with sovereign governments is not something that the vast majority of private equity firms who have the 150 billion of dry powder that are, you know, 90+% focused on the counties that Dave mentioned, that's what they're focused on. And frankly, that may be a little bit more, for a lot of them, their comfort zone. There's many, it's a very short list of firms that I think have the people deployed overseas, because it's very hard to fly in, fly out. You can't really do that, and have the staying power to deal with sovereign governments, go in on the ground floor, be there through production, and then actually the important thing is, you know, managing to get out.
Yeah. Dave, I can't see that. One quick question, because then maybe we have time for one or two from the audience. I mean, what do the U.S. investors, the equity investors, want? Do they want the companies that they put money into going outside the 5 counties you're talking about? I mean, do they want them worrying about Egypt, for instance? No. Even though they can make a lot of money in Egypt, are they saying we don't want that risk?
No, they'll take the cash flow from Egypt, but I mean, look at Apache as an example. They have Egyptian assets, but they're getting rewarded for a new discovery in southern Reeves County. And so the investors the investors want, they claim they want return on capital. I'm not sure they want that. They want growth, but some measured growth. But if you look at where equity's being, it's being focused in very core parts of the Eagle Ford, but really in West Texas, both the Midland and Delaware basins. That's really where the capital's flowing. And you won't see capital go to the Tuscaloosa Marine Shale or the Granite Wash or some of these other plays that absolutely just destroyed capital over the last 3 or 4 years. And so even in a $100 world, weren't making a good return. So investors are voting with their pocketbooks and investing in companies with good balance sheets and good acreage and good zip codes. And in the U.S., that means the core parts of the Midland, Delaware basins, and bits and pieces of the Eagle Ford and the Bakken.
But I'd say you can't, if you've been, I think anyone who's been a CEO for more than a couple of years and survived, and certainly the attrit rate for CEOs is a lot higher, you cannot, and I'd say should not, run your company for what some 20-year-old hedge fund guy happens to mention to you, what they want you to do next month, because you're taking an industry that has 20 or 40 or longer life assets and you're treating it like the fashion business. What are you wearing this season? Is it Permian or what? So you can't constantly chase that. That's idiotic.
But you're absolutely right.
It drives bad returns.
You made a good point before that the function of private equity is to spend the time longer than the elevator talk to understand the investment thesis that the company, and it sounds like a lot of this international stuff is outside the elevator talk. People aren't getting it in the U.S., which creates an opportunity, I think, for private equity, as you say.
It's a bit more bespoke. It's not, as repeatable cookie cutter, easy to understand.
Can we take, you
got 1.5 minutes.
1.5, I can't see because of the table, but do we have any questions from the audience?
Hi, thanks a lot, guys. Ian Niebuhr from RS Energy Group. Just wondering if you guys have seen any evidence of the next wave of international independence being capitalized, and if that's starting to happen. I know you're here trying to do that, Dave.
I think, we're doing our best, as is Marcel and Carlyle guys, but relative to where are the independent? The UK independent?
Well,
nobody. It doesn't exist anymore. I think it's been gutted, and maybe go back to your pregnancy analogy. It's like first month of gestation of the new generation of them, but that's okay. You can't. Also, maybe to your point, you can't rush it, and the seeds are being sown now to generate high quality independence that hopefully the public market will be ready to receive in a few years. But I don't think it's there right now.
But it is true, Colin, isn't it, that if you compare the UK scene to 10 years ago, when you had Enterprise, you had Lasmo, you had Norway Saga, you had this whole category of independence of a sort of reasonable size. British Gas is now out of the market. It's gone. There's nothing there. There's nothing left.
I think EnQuest is the nearest you've got.
Nearest.
And unfortunately, the timing there is not good, but it's actually a terrific company.
Yeah.
And, it's probably fortunate to still be here. Yeah. But, I think that it'll survive, and it'll be for some people, it'll be a terrific investment, actually. But we need more EnQuests. And I do think that there's an inertia. Mm-hmm. There's the big E&P companies that are dragging their feet on the way out. This whole decommissioning thing is a drag on that as well. I think that the Oil and Gas Association are doing their best to try and oil the wheels, but they probably just don't quite have the teeth that they need to actually force things through at a pace. But there is capital available, I think, and there is a will to do something. But
it just has to start to move.
As you know, delays cost deals, and
Well, listen, I think we've run out of time, so unfortunately we can't take any more questions. But I think the panel's done a great job in trying to kind of unpick some aspects, not all the aspects of this pretty complicated question. But I think we should thank the panel for the discussion.